We have seen a broad-based rally across Asia, driven by a number of factors, of course. But to get more perspective on that and to understand what the outlook really from here on is, we are joined on the show by Jim Walker, founder and managing director at Asianomics. He joins us on the phone line from Hong Kong. Now, Jim, this broad-based rally that we've been seeing play out across Asia, would you say it's more a factor of liquidity that is driving this rally, or would you put this down to fundamentals?
Yeah, I mean, it's a broad-based rally everywhere other than China, which is quite a big part of Asia. China really hasn't been participating very much over the course of the last couple of weeks, and if anything, and again today, the stock market's down in China. Elsewhere, I think the markets are rallying on the back of what's happening outside of Asia, which is principally some quite good news coming out of the United States, and seems to be reasonably fair good news. So this is a sustainable uptick in US growth. And then the hope that something is going to be done about the problems in Europe. Everybody seems to be ignoring the fact that Europe's in recession now, and they're concentrated on how much money the central bank's going to print to save Greece. I think that's a passing fantasy that all of the problems are over in Europe. They're far from over. So the rally has some support, real support from the US. It's not affecting China because China has got its own problems. And I think that Europe is, I'm afraid, going to come back and bite us quite hard. This is a time to be a bit more cautious about these rallies rather than to be going all in.
Sure. Now, Jim, you had the Bank of Japan just 2 days back saying that it is going to increase its asset purchase program by something like 10 trillion yen. You have the second round of the LTRO coming out of the ECB at the end of this month. And also there's talk about a likely QE3 coming out of the US. We don't know if that's going to happen. But clearly, this is indicative of a lot of liquidity coming into the system over the course of the next few months. Would that mean that Asian equities are going to get driven up higher, even if fundamentals don't really, support something like that happening?
Yeah, it's certainly possible that could happen, but the fact that all of these institutions are announcing liquidity injections, including the Bank of England, which announced another £50 billion quantitative easing, really should be telling us something. It's telling us that the world is in trouble. It's not telling us that things are good. And certainly while it can spill over into equities, it tends to spill over much more when you've got this liquidity-type rally into things that are in much shorter supply than equities, and that means commodities. So let's look forward to $150 oil, and let's see how happy markets are about that. $2,000 gold. Certainly I would be happy about that, but it's maybe not everybody's cup of tea. But there's an easy way to play this whole thing if you believe that this is what the central banks are about to do, and that's just buy commodities. Don't buy equities. That's silly because they don't go up anywhere near as much as the commodities.
Right. Jim, afternoon, given the kind of levels that we're seeing and the kind of performance that we've seen for the Indian markets, we have become the best performing index globally. Do you think that we are likely to continue this outperformance, or do you believe that, some of the structural negative factors still are dominant across the emerging markets, particularly the Indian region?
Well, the good news in India is that the central bank has finished the rate tightening program. I think we all know that the RBI is going to begin cutting rates during the course of this year. But I really do think that the markets have kind of got ahead of themselves now. We wouldn't be recommending clients to be buying into the Indian stock market at these levels. We like a lot of the companies, and we like them a lot going forward for the next 5 years. But the rebound has been very vicious in India, and to be quite honest, it's come at a time where the government has yet to show its cards in terms of getting serious about the fiscal deficit and getting serious about bringing government spending back under control. Everybody is looking to the RBI to cut interest rates. If the government doesn't deliver, those interest rate cuts are not going to happen. And at that point, the markets will actually start retracing what they've gained. So we're quite happy to let the rally keep going just now. I don't think there's much more in the way of legs on it. As we stand just now, and wait for the government to actually show the colour of its money. In other words, cut back on government spending and start balancing the budget again. If that happens, we'll be happily telling people to get back into Indian equities in a big way. But the track record so far over the last 2.5 years is simply appalling from this government.
Right, and Jim, lastly, you've had, just for taking the focus back to Europe, you've had Greece extract something like a 70% haircut from private bondholders. Now, since that has happened, what's to stop, other problem economies in the region like Ireland, Spain, Portugal from not demanding similar concessions on the debt that is held by their private bondholders? And again, should this happen, what's the impact of this you see on the banking sector at large? Do you see some sort of a crisis building up within the global banking system if something like this were to happen?
Yeah, it surprises me that people aren't putting those logical thoughts together the way that you've explained them. I think you're exactly right that if they can do it for Greece, then of course these other countries are going to turn around and say, why are we servicing our debts 100%? Why isn't somebody taking a bit of a haircut in our debt? Particularly countries like Portugal and Spain are going to be saying that. And at the same time, we're actually just heading into recession in Europe. So the worst news is way ahead of us. It's not behind us as regards European debt levels. I think people have kind of overlooked the fact that they've been concentrated on government and sovereign debt problems in Europe. That in actual fact, the corporate sector in most of these countries has much, much higher debt to GDP ratios than the governments. And as we move into recession, what we know from experience is that many of those debts are going to go bad. That's going to go onto the books of the banking system. And when it goes onto the books of the banking system, guess what? Then the banks pass it on to the governments. So government debt is going to go up in Europe. It's not going to come down over the course of the next year. And with it, the banking system is actually going to get weaker rather than stronger, which is the result of, inevitable result, I'm afraid, of every recession that we've seen so far in history, and this one will be no different. And when we get recessions, equity prices go down, they don't go up. I'm afraid that's what lies ahead in Europe, even though it seems to think things are well on the mend at the moment.